Working capital management involves managing the cash requirements of a business to ensure that it will be able to sustain its operations in the short to medium term. Working capital is defined as current assets less current liabilities. If the result is positive, it means there are more current assets than current liabilities, and these assets are funded by longer-term debt or equity. It therefore shows the amount of an organisation's capital that is working to fund short-term operations. However, if the result is negative, it can mean that cash flows from the organisation's short-term operations are helping to reduce the organisation's longer-term capital needs. While a negative result can be seen as a significant liquidity concern, in some cases it can also reveal strong cash management, such that cash is not sitting idle or tied up in inventory and accounts receivable. Woolworths Limited is a large retail company in Australia, operating supermarkets and hardware stores. At the end of the 2015 financial year, Woolworths had current assets of $7.66 billion and current liabilities of $9.17 billion. Working capital is therefore negative $1.51 billion. This indicates that Woolworths could not meet all of its current liabilities at this time using current assets, highlighting a potential liquidity concern as the current ratio is below 1. However, when we consider the business operations of Woolworths, it is likely that they have very strong cash management techniques. That is, having a significant proportion of cash sales, minimising inventory holdings and having minimal accounts receivable, whilst also extending accounts payable days out as long as possible. To help us further analyse an organisation's working capital position, we can focus more specifically on the three major components of short-term operations, being inventory, accounts receivable and accounts payable. Here, we can calculate the cash cycle and the operating cycle. These allow us to determine the organisation's funding gap. That is, how long and how much the organisation needs to fund its short-term operations from longer-term capital funding sources. The operating cycle determines how long it takes from the initial inventory purchase to the collection of cash from sales. The cash conversion cycle deducts the time taken to pay suppliers from the operating cycle, helping to calculate the net time that cash is tied up in this process. Going back to our Woolworths example, we can use information from the profit and loss statement and balance sheet to work out the average inventory period, the accounts receivable period, and the accounts payable period. Not surprisingly, Woolworths' accounts receivables period is very low, which we would expect for a retail store where most sales are paid for in cash. The overall cash conversion cycle is negative 5.46 days. That is, it is able to purchase its inventory, sell it to customers, and receive payment before it makes payments to its suppliers. This highlights that Woolworths generates cash funding from its daily operations, which reduces the need for it to rely on longer-term capital injections. To recap, understanding working capital is very important for an organisation. It helps determine the efficiency of cash management from daily operations and also whether access to additional longer-term capital is required in order to fund operations.